Markets are finally heating up. Tariffs are finally getting figured out. Bitcoin ETF data is up, and a couple other indicators that haven't moved in a while are signaling green. In this video, we're going to cover all the macro. I'm going to go through bullish news topics, some big acquisitions made. We're going to cover the most recent tariff updates. We're going to look at some charts, and at the end of the video, I'm going to talk about how I see this playing out for around the rest of the year. And no, this mic is not plugged up. I'm in an Airbnb here in Antwerp, Belgium. It looks pretty cool in here. You see the mirrors and stuff. This was just on the shelf over there, so I figured I picked it up because I got some stuff to say. All right. So without further ado, none of this is financial advice. Let's jump straight into the video, starting off with the tariffs. So the United States and the UK, I was just there a couple days ago. They have the coolest downtown. Anyways, I digress. The United States and UK reached a historic trade deal, and this deal provides American companies unprecedented access to UK markets while bolstering US national security. This is a great thing for America, and the UK will reduce or eliminate numerous non-tariff barriers that unfairly discriminate against American products, and they think that this actually turned out to be a great deal for both countries. So it says here, this trade will significantly expand the United States market access in the UK, creating $5 billion in opportunity for new exporters for US farmers, ranchers, and producers. And it talks about all the stuff it includes here. The reciprocal tariff rate of 10% as originally announced on Liberation Day is still in effect, and the United States will agree to an alternative arrangement for the Section 232 tariffs on UK autos. So under the deal, the first 100K vehicles imported into the US by UK car manufacturers each year are subject to a reciprocal rate of 10%, and any additional vehicles each year are subject to 25% rates. Now, here's the weird part of the details of this deal. They're actually not groundbreaking. They're kind of mid, to be honest. So the first reason is the UK only makes up about 3% of United States trade. So it's really a drop in the bucket. The 10% tariffs on goods from the UK into the US is still remaining. They were really uptight about it, but it's the same thing. And now, I don't know, maybe they're just accepting it because that's just the way it is and it's the US. But at least the threat of 25% tariffs on everything has been put to bed. So it's like, why is the market pumping off of this news? I think personally it's because the details don't matter as much as the certainty of the actual deal, them coming to an agreement. Because the market doesn't like uncertainty. The market now knows the rules of the game when it comes to US and UK trade. And I think people are kind of finding hope that more deals will be made in the future based off of how this one is going. And a lot of people is waiting on the deal with, obviously, China. But only time will tell with that. The crazy thing is you still have economists playing the same game where they're projecting GDP, payrolls, and PCE because they think it offers them some kind of edge, and it's important to keep those things in mind. But in this kind of market, it doesn't really matter at all because things can change with one tweet or one announcement. And you know, people keep talking about recession. What it boils down to is that this is a policy-driven slowdown. This is tariff-induced. It's not a credit crisis. Like every recession, depression, which ends up making the market drop precipitously, is normally caused by the Federal Reserve making it easy to borrow money in some aspect of the economy. Go back to the Great Depression. It was easy to borrow money after the war to finance appliances, cars, and things like that. And once interest rates rose, that caused the Great Depression because it was kind of the Federal Reserve. The Federal Reserve was just created in 1913, so this is kind of like their first taste of, you know, fucking shit up, pretty much. And if we go to 2008, it was super easy to borrow money to get a mortgage on a car. You know, the famous movie Big Short, you know, Steve Carell knocked on the guy's door and was asking for a guy's name, and he's like, that's my dog. So basically, it was so easy to borrow money back then that you can get a mortgage in your dog's name, right? So credit is easy. This isn't a credit issue. This is literally all tariffs, and it can be reversed just as easily. Right? And we see that, right? We see what happened with the UK and the market's just pumping, right? And through what I'm looking at, I think it will reverse, especially as the labor market softens and inflation continues to drift lower, right? You have inflation at 2.9%. The Federal Reserve's target is 2%. So they have been hiking rates for years, and now inflation's starting to come down. It's close to their target rate. Well, real inflation will still have a little ways to go. But, you know, things aren't looking that bad from an inflation standpoint. And if you need proof that the market is being driven off of tariffs right now, not inflation, not earnings growth, not anything else, just tariffs, here's proof. You can see the drastic revisions to Wall Street forecasts. So in December, this was their predictions in December, right? Deutsche Bank, BMO, Yardney, Oppenheimer, Barclays, Goldman Sachs, Citibank, Bank of America, And now after the tariffs, this is what they're all predicting, right? So it's like the economy is one thing, and that's why you have all these economists talking about GDP and all that. But the markets don't really give a fuck about that, right? The markets and the economy is two separate things. And just because something's happening in the economy, the market may look at it in a different way. It's kind of like the left and right brain hemispheres. Like we know we should do something, but sometimes we still do it and vice versa. Economy and markets are kind of like the same thing. All right, so let's look at some charts here. You got the United States Central Bank still selling off these junk bonds. It's just still coming down, down, down. This is a very, very great signal. We got this cross here, right? M2 money supply is right back at all-time highs, right? So something needs to be done there. You got gold kind of breaking down. Gold is normally going up during inflationary times, so it's to be expected that since inflation is kind of cooling off, that gold should be dropping, but it kind of looks like it's consolidating. You have the S&P, we're back above our 62 EMA, but we're not back above our 200-day EMA, and we did get a cross right here. So as you can see, anytime the 62 is on top of our 200, the market's in bullish conditions. Anytime it's under, that's usually not a good sign. If we go back and look, you saw when it was over here, we were pretty much in a bear market. Kind of same thing here. We had this big drop. Like anytime it's over, it's a drop, but it can turn back just as quickly. Same thing here with the Dow Jones. Same thing here with the NASDAQ. Everything's kind of, looking the same. And then Apple has been breaking down. So Apple just lost a court case to where they had it to where you had to use their payment processor in the App Store. So you get hit with like this 20% fee or some large fee. And I was reading on this like last week. And I just remembered when I pulled up the Apple chart. But now users don't have to use the payment processor inside of Apple. They can now use their own like PayPal or something like that. And they can even say, pay here with Apple or come here and pay with PayPal and save whatever percent. And then they also just got hit with a class action lawsuit where they were like gathering information through Siri that they wasn't supposed to be gathering. They were monitoring people's conversations. So Apple's kind of been taking some hits, and it's no surprise that the S&P is down because Apple makes up the largest weight. And I think with this drop, they actually were overtaken by Microsoft in terms of market cap. See, my Siri's on right now. Listen, I didn't even know. I'm gonna have to go to that class action lawsuit and claim me some stuff. Anyway, if we look at Bitcoin, we are hovering at $103,000. I really want to make this 100K support so that, we can kind of keep rising. We bottomed out at 74K, and now our 62 is creeping up above our 200-day, which is a very bullish sign. Now, the market does like to come back and retest the 62. So if we come back down to 90, 85, I wouldn't take that as a surprise. If we look at the total crypto market cap, same thing here. We're hiking up. And eventually we're going to we also have stablecoin dominance dropping. So when stablecoin dominance is dropping, that means people are buying crypto. This is USD Tether and this is USDC, so that's a good sign. The chart I really want to look at is the Bitcoin dominance chart. This is the largest 3-day drop in Bitcoin dominance since November of 2024. This is a good sign because that means people are taking money from Bitcoin and using it to buy alts. And the fact that they're doing this and Bitcoin is still at $103,000, that's really, really good. That's a really bullish sign. But what we've all been waiting for, Ethereum is finally pumping. We're at 2,400, almost 2,500 in ETH. We need our 62 to get above our 200. But this is a good sign. We want to eventually make this support again and start bringing our way up. I do still expect to see a 7,000 to 10K ETH here in the near future. We did just have the Spectra upgrade. It was successful. And this upgrade raises the staking limit and improves wallet usability amongst other enhancements. So basically this is making ETH more usable. And we've had a lot more Ethereum improvement proposals or EIPs in recent history here, the past couple months. And there is a large association with ETH's price increasing with the amount of successful improvement proposals. So it's good that they're making ETH better because we need to have ETH better if we're going to have people using it. And lastly, look at the ETH to BTC ratio. This shows ETH versus Bitcoin. We finally got a nice big green candle above our 62. We haven't had a candle close above our 62 since December, right? And this is a big green candle. We want to see, I'm going to go to the weekly here. I want to see a big green candle close on the weekly and start to print consistent candles. We got to get above our 200 and we need to get above our 62. But this is a really good sign. ETH always outperforms Bitcoin in bull markets, but it kind of has been lagging on this one because the Bitcoin ETF kind of gave Bitcoin a head start. The ETH does have an ETF as well, but institutions aren't quite as sold on ETH just yet. But if you've been watching this channel long enough, we know utility trumps store value all day long. So we know it's just a matter of time. It's a matter of if not when. So if you ain't holding ETH, you best believe it's a sin. Okay, I'm done. We take a look at the fear and greed index. We look at the 1 year. We can see that we kind of bottomed out on the fear, and people are getting greedy. They are speculating, right? All-time highs for the year, for the past year, was November. We still have a ways to go a little bit before we get there. So it's a good practice to take some off the table when people are greedy, buy when people are fearful. If you just buy and sell based off of this, you make some pretty good money. If we look at the maximum, we still have a ways to go before we're back at that 2020 levels. We're at about 70, 90 was the all-time greed since this metric has been created. And guys, here's another this is a huge signal right here. On April 24th, we got a breadth thrust signal. And this is only the 16th time that we've got it since 1939. So if we look up what this indicator is, it says it's a technical indicator used to ascertain market momentum. It's computed by calculating the number of advancing issues on an exchange, such as the New York Stock Exchange, but divided by the total number of issues, so advancing plus declining on it, and generating a 10-day moving average of this percentage. This indicator signals the start of a potential new bull market when it moves from a level of below 40%, indicating an oversold market, to a level above 61.5% within a 10-day period. This is a rarely occurring sentiment. It was created by the guy named Zwig Breath, and there has only been 14 thrusts since 1945. The average gain following each of these thrusts was 24.6 in an average time frame of 11 months. So this highlights the fact that the majority of bull markets begin with the bread thrust. So if we go back to our picture here, we went from a market where only a few stocks were driving gains to one where nearly everything started participating simultaneously. So when that many flips happens from red to green in just 10 trading days or less, like we talked about, it signals the start of a durable move higher. Not a dead cat bounce, as markets become less sensitive to stock earnings. So if you take all this together, factoring in falling credit spreads, compressing volatility, internal strength signals like this, and then a myriad of other technical bottoming signals, I think this suggests that the bottom is in, or at least the bottoming process is in. Let's keep moving further. We've also started to see the flows turn. So treasuries recorded the largest 4-week inflow since Q1 2023, and Bitcoin ETFs saw their third highest inflow week of the year. So these aren't euphoric flows by any stretch of the imagination, in my opinion. But like I said, I think they're bottoming ones, suggesting that the worst of the fear trade is behind us, and institutions and funds and that are managing large amounts of money, their risk on meters are signaling on, and they're buying more risk on assets. So now, what about the U.S. consumer, the weak link that everyone's worried about? Well, they're doing pretty good. If you look at credit card delinquencies, they're actually falling. And also you have real wages, which are inflation-adjusted wages, they're remaining positive, while spending is actually becoming more selective. Like, people are still spending a good amount of money at Starbucks. So look at some more bullish news. You have Coinbase. They just made the largest crypto acquisition in history, as they just bought Deribit, which is the world's largest crypto derivatives exchange, and they bought it for $2.9 billion. So crypto derivatives allow traders to speculate on future price movements without actually owning the underlying asset, and it's a big business. It's literally a casino, right? And I think they paid like $700 million in cash, and the rest were in stock. That's a pretty huge deal, guys. Here's another huge piece of news. You have Robinhood using blockchain technology to enable U.S. equity trading in the European Union, in the EU. So in a nutshell, European customers will now be able to trade U.S. stocks on Robinhood via the blockchain, guys. And it's like several regulatory challenges has historically prevented Robinhood from, offering U.S. stock trading to its EU customers. But now it's like, under the EU's current regime, blockchain no longer increases regulatory complexity. It actually decreases it. Guys, I don't know if you realize how huge this is, but like if you go back to the tech boom, that was one of the largest booms in history. But in order to participate in it, you have to be a U.S. accredited investor. So it was two barriers to entry. You have to be a United States citizen and you have to be an accredited United States citizen. Now they're making it so that they're starting with the EU, but eventually they're gonna branch out to other places. So it's like crypto is so good because it's a global playing field. Like anyone can buy it because all you need is a smartphone. Well, they're trying to make it like that with stocks. And this is why I've been talking about asset tokenization for the longest, and this is why Larry Fink, the CEO of BlackRock, is so excited about tokenizing bonds and stocks and assets, because it's just going to increase the United States' staying power and their reign, because now the world will be able to speculate on their assets. Everyone wants to buy assets in the United States, and this is just one domino fall in that direction. And it's going to increase the amount of liquidity coming into the United States. Like, that's a pretty huge deal. Couple more bullish pieces of news. MasterCard adds crypto stablecoin settlement support for merchants. So now you'll be able to pay with stablecoins anywhere where MasterCard is accepted, and MasterCard will switch it to United States dollar at their bank. So it's like stablecoins is now becoming US dollars, even though it already was, but you guys get what I mean. The Arizona House passed a bill to establish a Bitcoin reserve. And then the UK seeks to become a world leader in digital assets, the UK finance minister says. So guys, now to wrap this up, this is what I think. I think the rest of the year is going to be bullish, especially if this China situation can get figured out. I think it's eventually going to get figured out. Like, it's the US, everyone wants to do business with the US. So I think tariffs will get eased, but it's possibly that China could still put up a fight. And if that gets dragged on longer, the bull market will be dragged on longer, I think. So I think tariffs will get eased optically, if not functionally. I think the Federal Reserve will lean dovish, and they will end up cutting. And I think they'll start to cut rates to counter the tariff drag, right? The tariffs is messing up the economy like they were fearing inflation would. So I think they're going to continue to cut rates because inflation is down, the labor market's looking good, and the tariffs are kind of fucking with the markets. That's like the only thing right now, the main thing, not the only thing. And I think earnings growth will actually be challenging for more corporations, but I think they'll benefit from trade policy clarity and deregulation. So we got Bitcoin dominance dropping, we got ETH pumping, we got the tariffs getting figured out, we got inflation down, we got the labor market strong, we got credit card delinquencies down, we got ETF data up, all these things, all these companies and countries wanting to get involved in crypto. So I think it's a good time to be in the market. So that's it for me. If you like this kind of content, make sure you like, comment, subscribe, share with a friend. Help us reach 1,000 followers. And if you want to join a community that stays on top of all this stuff and you learn how to manage your money like a professional institution, yield farming, get access to the best research before I put videos out on this channel or on my Crypto Noah channel, give that a follow. Click the link in the description, book a free strategy session, or you can just click the link in the description and join our group for free. But with that, thank you so much for tuning in. I love every single one of you who's watching, and I will see you on the next video. Take care and trade safe.